Look at this gauge. In 1991, India's foreign exchange reserves, the money a government holds to buy essential imports from the rest of the world, were draining fast. They fell so low that the country could not even finance 2 weeks' worth of its petroleum supply. For decades after independence, India operated a mixed economy. The state successfully built a heavy industrial base and secured a steady domestic food supply. But it also layered the entire system in suffocating bureaucratic red tape. Throughout the 1980s, the government poured money into defense and extensive social programs. While these areas are crucial for a developing nation, they do not generate immediate financial returns to refill the treasury. To cover this widening deficit, the government started borrowing heavily from both domestic and foreign lenders. The plan relied on massive public sector undertakings, state-owned companies, turning enough profit to offset the costs. But their revenues continually fell short. By the late 1980s, expenditure vastly outpaced income. The country couldn't meet its external debt obligations, creating a severe balance of payments crisis. As imports grew and exports stagnated, inflation soared for everyday citizens. This combination of unsustainable debt and nearly empty foreign reserves stripped the country of its economic independence. To avoid defaulting on its sovereign debt, India had to look outward for a rescue. India approached the International Monetary Fund and the World Bank for emergency help. They secured a $7 billion loan to manage the crisis. But international lenders rarely issue blank checks. They required India to open its markets and severely reduced government intervention in the economy. India agreed, announcing the new economic policy of 1991. This policy blueprint attacked the crisis down 2 distinct paths: short-term stabilization and long-term structural reform. The stabilization measures were immediate responses to stop the bleeding. The goal was to bring rising prices under control and fix the balance of payments. As a first step, the government devalued the rupee, which immediately increased foreign exchange. The structural reforms were long-term measures designed to improve industrial efficiency. They were built on 3 pillars: liberalization, privatization, and globalization. It was a strategy of national economic triage. First, apply a tourniquet to halt the collapse of the foreign reserves, and then perform open-heart surgery on the mechanisms driving the economy itself. Under liberalization, the government abolished the notorious industrial licensing system, where entrepreneurs needed official permission for almost every business decision. They also stripped away restrictions on goods previously reserved for small-scale industries, and simplified the tax code to encourage compliance. A key part of this was overhauling the financial sector. The Reserve Bank of India shifted its role from a strict regulator that fixed interest rates and dictated lending to a facilitator, allowing banks to make their own commercial decisions. Next was privatization. The state began disinvestment, selling off equity in public sector enterprises to private investors. To improve efficiency in the companies they kept, the government granted elite state firms, designated as Navratnas, the autonomy to operate more like private corporations. Finally, globalization integrated India into the world economy. The government dismantled quantitative restrictions on imports and slashed high tariff rates, and aligned its trade policies as an active member of the World Trade Organization. The immediate effect of this global integration was the explosion of the services sector. With a large, skilled, and relatively low-cost workforce, India quickly became a massive outsourcing hub for global IT and business process outsourcing services. Together, these 3 pillars dismantled decades of strict state control. Indian industries, which had grown accustomed to a protected domestic environment, were pushed directly into the competitive fires of the global free market. Look at this chart mapping sector growth. While industry and agriculture fluctuate, services breaks away, pulling GDP upward alongside surging foreign direct investment. The 1991 crisis reversed completely. Foreign exchange reserves grew from $6 billion in 1990 to $646 billion by 2024. But this macroeconomic success masks an uneven reality on the ground. While industries like IT, pharmaceuticals, and auto parts thrived in the new global market, the agricultural sector, which employs a massive segment of the population, began to decelerate. The structural reforms reduced public investment in agricultural infrastructure, like irrigation and power. Coupled with a partial removal of fertilizer subsidies and a push to export cash crops instead of domestic food grains, the cost of farming rose while global competition undercut local prices. Many domestic manufacturers faced similar pressures. Stripped of high tariff protections, local factories suddenly had to compete against a flood of cheaper imported goods, stalling domestic industrial employment. The 1991 crisis forced an economic pivot that undeniably saved the nation from bankruptcy. It dismantled an inefficient system and built a modern global powerhouse. But in making that pivot, the state traded a crisis of insolvency for the modern challenge of deeply unequal growth.